Welcome everyone to our year-end accounting and disclosures update webinar. We're going to go ahead and get started. Before I pass it off to our presenters today, there are a few housekeeping items I want to go over. So just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we also encourage you to ask questions. So in the webinar pane, you can see a questions box and you can go ahead and type in your questions and hit submit. Our presenters will be answering those questions throughout the presentation as well as at the end as time allows. And then I want to make sure everyone has good audio quality. So if you're using a telephone, make sure you select the phone call audio option. And if you've selected, or if you're on your computer, make sure you select the computer audio option. And if you're looking to get CPE today, you need to make sure that you're on a personal computer using your own unique URL, that you're logged into our online software for at least 50 consecutive minutes within the scheduled time frame, and actively respond to 75% of the polling questions. Today, we're going to have 4 polling questions. Make sure you answer at least 3. And you also need to complete the evaluation survey at the end of the webinar. Also, please note that everyone's going to be receiving a link to the downloaded slide deck and the recorded presentation today within the next 48 hours. Today, we hope you learn to understand changes to the accounting standards that will become effective during 2019, learn about proposed changes currently being considered by the FASB, understand potential factors to be aware of stemming from these changes to help CFOs and their accounting teams effectively communicate with their board of directors, bankers, auditors, etc. And with that, I'll go ahead and pass it over to Isaac and Brad.
Thank you, Marie. Good afternoon, everyone. Thank you for joining us today for our accounting update. So today we're going to focus on the standards that will become effective during 2019 and how organizational leaders may best approach this change, especially as it pertains to your accounting and reporting. So my name is Brad Cummings. I'm a senior manager in the Armanino Dallas office. I've been with the firm for 12 years, where my focus has been on providing attestation services to our corporate clients, focusing primarily on the technology and manufacturing industries. I currently assist our clients today and prospective clients with understanding their businesses and aligning our service offerings provided by the firm to help them navigate change and uncertainty. I'm fortunate enough to be joined today by my partner in crime, Isaac Peace. Isaac is a senior manager in our Dallas office, and he's one of our national thought leaders around complex and technical accounting issues. And he drives the national training for our auditors and shapes the audit methodology for our public and privately held corporate clients. So, Isaac, thank you for joining us today, and tell us a little bit about the clients you serve at Armanino.
Absolutely. Thank you, Brad. I serve clients primarily in a couple of different industries: the technology space, real estate industry, and financial services. But I do have clients also in other industries as well: professional services, manufacturing, distribution, just to name a couple of others.
Awesome. Thank you. All right. So the next thing we'll do is we'll look at our agenda. And so today, let's see. Well, Marie, can you help me, please? Sorry, I'm trying to get it to the agenda.
Oh, no worries. We're actually going to go ahead and start with our first polling question to get a feel of the audience. So we want to ask what type of organizations you work for. So if it's a public entity, a private company, nonprofit organization, public accounting, or other, let us know. We'll give you a few seconds to weigh in there. Just as a reminder, if you're looking for CPE, make sure you're answering at least 3 of our polling questions. Okay, and we'll go ahead and close the polls now in 3, 2, 1, and go ahead and show the results. Okay.
All right, good. Got a good mix today. That's great.
Awesome. There you go.
All right. Thank you very much. Appreciate it, Marie. All right, so looking at our agenda today for the accounting standards we're going to discuss, we'll start with revenue recognition. We'll also talk about leases, cash flows, and how the changes there for presentation will affect certain businesses, income taxes related to the transfer of assets for intercompany, and also look at business combinations, the impairment analysis for goodwill, accounting for financial instruments, our fair value measurements change, consolidation under the new company rules for VIE, and we'll also look at some other pending developments that'll be shaping the future as we go into 2019. All right, so our first topic today, looking at ASC 606. So we've been talking about RevRec for the last 5 years. I know our finance and accounting teams have been diligently assessing the impact of how this change will affect their organizations for quite some time now, and D-Day is finally here. So that being said, Isaac, at this point, what are some high-level points that we want to consider about the change? And most importantly, what are a few takeaways for leaders to be communicating to their boards, stakeholders, and lenders?
Yeah, absolutely. As you said, revenue recognition, the standard's finally here. This is the first year of implementation. It's already effective for public companies, but private companies are gearing up to adopt the standard for the upcoming year. But the standard applies to any company or organization that enters into contracts with customers to transfer goods or services. There are some exceptions to the requirements of this standard, specifically those that are within the scope of other standards, such as insurance contracts, lease contracts, and those types of guidance. This does supersede the recognition requirements in Topic 605 and most other industry-specific guidance related to contracts with customers. The core principle of the standard, though, is that the entities need to recognize revenue in relation to the transfer of promised goods or services to customers in an amount that reflects what companies expect to be entitled to as part of that contract. The standard does change. There's 5 steps now as part of the process. I'm not going to go into depth into each one of these because there's been so much information out there and it's been talked about for such a long period of time. But steps are to identify a contract with a customer, to identify what the performance obligations within each contract are, to determine the transaction price, to allocate the transaction price to the various performance obligations that have been identified, and to recognize revenue when or as the company satisfies the relevant performance obligations. This does also impact the costs associated with securing contracts, so things like commissions that are paid on those contracts. Those also have to be deferred and recognized in accordance with when the revenue is recognized. Basically, it falls under the matching principle of the accounting standards. This week, This week, the ACPA is having its annual SEC and PCOB update conference, and specifically the SEC has called out some lessons learned from public companies that are applicable to everyone, and then some things that private companies can learn from the work that the public companies have put in. But topics specifically around performance obligations, and really the nature of the obligations that they've identified, why the goods or services are distinct, and disclosure of what the remaining performance obligations are. There's also been comments from the SEC to issuers related to information provided in other parts of filings that appear inconsistent regarding number of performance obligations in a contract. Variable consideration, really the determination of what the transaction price is and how a company is going to estimate that variable consideration. The timing of recognizing revenue, so that really it needs to happen when control transfers, and how the revenue is being recognized over time, and specifically accounting for licensing arrangements. Again, I touched on this in the previous slide, but the cost to obtain a contract, need to identify and really have a clear policy on the appropriate costs that need to be capitalized, the amortization period, and what disclosures need to be made in the footnotes of the financial statements, including any election of the practical expedients that are out there. Gross versus net presentation. There's oftentimes judgments that are involved related to gross versus net presentation in revenue, including the assessment of whether the company controls the goods or services being provided to the ultimate end user in the contract agreement. And finally, the disaggregation of revenue. The disclosures have oftentimes been inconsistent with information provided in various parts of filings or financial statements, such as in investor presentations. So that being said, what it boils down to is some things that CFOs and accounting teams need to be aware of as they adopt this standard. Get out in front of this early. Evaluate the impact of what the requirements are going to be and what it's going to have on your operations. And specifically, consider things like the timing and the changes in timing of revenue recognition. Certain industries, it's going to accelerate. So, for example, in technology companies, previously under the former guidance, oftentimes contracts were combined into one unit of accounting and recognized ratably over the contract period in accordance with SAB 104. That option really goes away, and revenue has to be recognized now in accordance with the performance obligations that are identified. So things like implementation costs now are going to be recognized up front versus included as part of the contract cost that's going to be recognized over the contract term. Why this matters is that CFOs and accounting teams need to be able to effectively communicate the impact this is going to have with their executive leadership teams, ownership, those charged with governance, audit committees, and those types of oversight organizations or groups. Specifically, things that to communicate with your board are the timing of recognition, the impact that that's going to have on the forecasts and operating budgets. Based on the change of the requirements, there may be an impact and changes, increased volatility in the timing of when revenue is recognized versus under the previous guidance. So there may be spikier in terms of ebbs and flows in revenue versus a smooth straight line. Bankers should be reached out to and contacted early to discuss the potential impacts of the covenants on the company's current credit facilities, or if they anticipate modifying those facilities, what the impact the standard may have on those modification discussions. And then with the auditors, it's really beneficial if you can compare and contrast the impact of the standard on your contract. So show what the impact was on the old standard and what the changes are under the new standards, and how that's going to change the timing of recognition. And then also discuss with them, talk to them early about the enhanced disclosure requirements. Particularly for private companies, the auditors can assist in helping give some direction and guidance on what needs to be included and some effective ways on compiling and gathering that information. So that's what I'm going to say on revenue recognition. But again, if there are questions on that, please feel free to submit those, and we are here to help with that however we can. Next topic we're going to go into is leasing. And again, this is a standard that's been talked about a lot. This one is the next big issue that's getting ready to be adopted, and there's been a lot of discussion this week in the SEC conference regarding the impact of the new lease standard. In terms of a snapshot and overview of this standard, most leases are now going to be required to be recognized on the balance sheet. So you'll have financing leases versus operating leases. The previous guidance, operating leases didn't have to be included in the balance sheet, but could be disclosed in the footnotes of the financial statements. This one's been talked about for almost 10 years, and the reason why it was brought up is because the SEC was concerned that smaller investors didn't have the manpower to be able to dig through financial statements to really get a good feel and understanding of the obligations and commitments that were out there under operating leases. And so they thought, if we can bring it all on the balance sheet, then it'll help level the playing field and increase transparency, or increase the transparency of the financial statements. Now, there are some exclusions to this standard, specifically regarding short-term leases. Those don't have to be recognized if the term of the lease is less than 12 months. They don't have to be recognized on the balance sheet. There are also some exclusions from the standard. So leases that or to acquire intangible assets, to explore for or use non-regenerative resources, so looking for oil and gas and those types of things, extractive activities, biological assets, leases of inventory, and assets under construction. The standard also removes the bright line test for determination of the lease classification, and lessor accounting largely remains the same. It does change certain principles under the lessor model to more align with the new revenue recognition standard that we just discussed. This week, as I mentioned in the SEC conference, some areas of focus that have been really talked about and stressed in the companies that are getting ready to adopt this, the implementation challenges that are being faced. So identification and capturing of known leases. This standard does have a new definition of a lease, and it really expands the requirements for companies to dig in and identify contracts and identify leases that they may not have thought about in previous years. Need to review contracts to identify potential embedded leases and make sure that your summary of leases and listing of leases is accurate and complete. There are potential software solutions and workarounds that are out there. The consensus at this point is that there's not a leader in the clubhouse in this regard. A lot of companies are still doing this manually, and they've found that it's been a better fit for them than trying to use a third-party workaround or system for that. And then also the internal controls over financial reporting. And this comes down to really how is the company classifying leases and capturing leases to make sure that listing is complete and accurate. From some companies that are farther along in the process, some things that they're running into are the recognition of a gross lease versus a net lease. how internal communications between the procurement or purchasing departments and the accounting function are working. Needs to be really good communication there. That'll really help avoid potential issues later in the process regarding the completeness of capturing the leases. And then certain disclosures around controls. From a communication standpoint, some things to be aware of. Some process owners, really be aware of the changes to your current responsibilities. So internal accounting people, your responsibilities are going to change and expand as part of this. There may be some changes to policies that have to happen, who can authorize purchases and leases and those types of things. And then what the implication of those operating procedures are within the internal organization. When talking to your board of directors or audit committees, it's really important to get out ahead of this and communicate the balance sheet and P&L impact that this is going to have on the financial statement specifically. From a balance sheet perspective, for every operating lease, the company needs to recognize a right of use asset and a lease liability that will be capitalized on the balance sheet. It's a big change from prior years and the prior requirements of the legacy guidance. And this is going to impact the financial metrics like your current ratio, your leverage ratio, and your return on assets. From an owner and investor standpoint, the disclosures are also going to be modified and changed. And specifically, when the effect of the change is not known or reasonably estimatable, companies are advised to consider additional qualitative financial statement disclosures to help financial statement users in determining the significance of what the impact of the standard is going to have on the financial statements once it's adopted. The expectation is that the disclosures are going to include a description of the effect of the accounting policies that the company expects to apply if determined, in a comparison with the current accounting guidance policies. And finally, description of the progress that the company's made in implementing a new standard and the significant implementation matters that the company still needs to address. The more we can communicate with boards of directors and audit committees and ownership on these matters, the smoother the process is going to go. And really the goal is to avoid surprises later in the process.
Yeah, I think that's such an important topic as you start to look through and see the true effect and the change. You don't want to get into the audit, obviously, and start discussing whether or not this has an impact on your financial statements and accounting processes or communicating that to the board. That's one thing we've tried to do is be proactive with our clients this year, let them know the change, assess the impact. Most importantly, start drafting those memos and disclosures so that way when you get to the end of the year and you're putting together your financial statements and disclosures, that information's already provided, reviewed ahead of time by your auditors, and then hopefully you're issuing your financial statements timely. And so, yeah, that's one of the things that we always encourage. You know, if you're not working with us as your auditors, and you do have auditors, we encourage you guys to have that discussion. Hopefully you already have before you get to year end, but that'll save you some time and headaches, most importantly. All right, looks like we're on to polling question number 2.
Yeah, so we'll go ahead and bring that one up. So what we want to ask is, have you started the process of analyzing the impact of the new leasing standard? So yes, no, or I don't know. I'll go ahead and give everyone a few seconds to do that. Just as a reminder, make sure that you answer at least 3 of our questions. We have 2 more left after this one. Perfect. And we'll go ahead and give everyone about 5 more seconds, and we'll close the polls in 5, 4, 3, 2, 1. Awesome. Let's bring up the results. There you go.
All right. So it looks like we're about 50-50 for yes and no for the assessment. For those of you who've already started to consider how the change will affect you for your accounting reporting, great job. We've had a good bit of runway leading up. There's still time, which is good news, but unfortunately with the adoption taking effect here shortly, we are running out of time. So I would encourage you to have those discussions with your CPAs and your auditors to see if the effect is going to be instrumental for you this year. Some industries, it's going to be a big change. Others, it's not. Definitely have those conversations, determining the effect on your organization, And then you guys can start planning now accordingly as you get into the end of the year. Most importantly, start looking to issue your financial statements, doing audits.
Absolutely. And I think, for public companies, this is something we're happy to have conversations and discussions about. Obviously, we can't come in and help with the implementation due to independence rules. But for private companies, we have a little bit more runway there. And this is something we have been able to assist several clients with to this point, and happy to talk with companies about assisting them as well as they move forward in the process. Moving on with the presentation today, the next kind of topic that we want to touch on is the statement of cash flows. And the FASB's issued two significant updates recently that will impact kind of presentation of that's included in the statement of cash flows. The first is Accounting Standards Update 2016-15, and it relates to the classification of certain cash receipts and cash payments on the statement of cash flows. And specifically, it clarifies the guidance for how these receipts and payments should be categorized and eliminated if needed. But the specific areas of focus outlined by this standard are, there's 8 different points. The debt payments and extinguishment costs. Specifically, these need to include all third-party costs, the premiums paid to repurchase debt in an open market transaction, and other fees paid to lenders, such as a prepayment penalty, that are directly related to the debt prepayment or debt extinguishment. This one's pretty straightforward. These need to be recognized as operating expenses, cash flows from financing activities in the statement of cash flows. The second point outlined by this standard is the settlement of zero coupon debt. So a deeply discounted debt with a zero or near zero coupon interest rate effectively includes a payment for principal and interest components at settlement. The portion of the cash payment that companies make that's related to the accreted interest on that debt discount should be presented as operating cash flows in the statement of cash flows. And then the portion related to the payment of the principal balance needs to be classified as financing cash outflows at settlements. This is only applicable to zero coupon debt instruments and other debt instruments with coupon interest rates that are insignificant to the effective interest rate of the borrowing, and it doesn't apply to any other debt instruments. The third point listed by the standard is the settlement of contingent consideration. Cash payments to settle contingent consideration liabilities made by an acquirer soon after a business combination should be classified as investing outflows. But the standard uses the term "not soon," but it's not specifically just defined. The standard doesn't specifically define that term. But the basis for conclusions that companies have reached has really been that it's a relatively short period of time, something in the neighborhood of 3 months or less. Payments to settle liabilities that are not soon after an acquisition, again, that term is not defined by the standard, but they need to be separated and classified as based on a couple of different ways. So payments to settle amounts of contingent consideration should be classified as financing cash outflows, and then any payments in excess of the amount of contingent consideration should be classified as operating cash outflows. The next point outlined by the standard is how to classify insurance proceeds. So specifically, the standard excludes proceeds received from company-owned life insurance or bank-owned life insurance policies. These need to be classified on the basis of the insurance coverage and really the nature of the loss. Lump sum settlements must be classified based on the nature of each loss included in the settlement, rather than just classifying the entire settlement payment in one category. The settlement of corporate-owned life insurance and bank-owned life insurance policies is the next point outlined by the standard. And the cash proceeds on settlement from these policies need to be classified as investing inflows. The standard does not specifically address the classification of premium payments on these policies, but they need to be classified, or they probably should be classified as outflows for investing or operating activities, or a combination of both based on judgments made by management. Once that judgment's been made, again, probably keep that policy consistent going forward from period to period, unless there's a change in circumstances around the policy. Moving on, distributions from equity method investees. Generally, returns of investment are classified as investing inflows, and returns on investment are classified as operating inflows. The standard outlines two different ways to look at that. The first is the cumulative earnings approach. So distributions received are considered returns on investment, need to be classified as operating cash inflows, unless the investor's cumulative distributions received, less than any distributions received in prior periods that were determined to be returns on investment, exceed the cumulative equity and earnings recognized by the investor. When such an excess happens or occurs, the current period distribution up to this excess is considered a return of investment and should be classified as an investing cash inflow. I know that was a whole mouthful of a definition there, but we're happy to talk further on that and help clarify if there are questions there. The second option for classifying distributions received is the nature of the cash distribution approach. So these are classified based on the nature of the activity that the investee has generated the distribution as either a return on investment, which is operating cash inflows, or a return of investment, which is investing cash inflows, when such information is available. So there's an accounting policy election that should be made for all equity method investments in an entity. And if an entity elects to apply the nature of the distribution approach, so the second approach outlined by the guidance, and determines that the necessary information for an individual equity method investee is not available, then the cumulative earnings approach should be applied for that investee. And if that happens, that's going to require a change in accounting principle, and it needs to be applied on a retrospective basis. The standard does not address the equity method investments measured using the fair value option. There is a new standard on that that we're going to touch on a little later in today's broadcast. So there's two more points outlined by this standard regarding classification of cash inflows and outflows. The first of those two is beneficial interest in securitization transactions. So when a transferor sells financial assets, such as trade receivables, in a securitization transaction, loans is another one, loans receivable is another one, but the transferor, in addition to any cash received, also typically obtains or retains some beneficial interest in the financial asset sold, such as the right to receive cash from the collections of those receivables or loans. Disclosure of any beneficial interest obtained by the transferor should be classified as a non-cash activity, and collections on a transferor's beneficial interest should be classified as investing activities. And the final standard, or the final point of the standard, is kind of a catch-all. It's receipts and payments with aspect of more than one class of cash flows. So certain cash receipts and cash payments that have aspects of more than one class of cash flows should be separated by their identifiable source for inflows or used for outflows, with each separated element classified based on its nature if it's not specifically addressed in the standard. So in situations in which these aspects can't be separately identified, the appropriate classification is going to depend on the activity that it's likely to be the predominant source or use of the cash flows for that item. There's going to be judgment that's going to be required to estimate the amount of each of these separately identifiable sources or uses within the cash receipts or cash payments. So this guidance is going to be effective for public companies. It's already effective this year. It was effective for years beginning after December 15, 2017. And for all other entities, it's going to be effective for this upcoming year. So years beginning after December 15, 2018, and any interim periods within fiscal years beginning after December 15, 2019. The standard can be adopted early. If an entity early adopts the amendments for an interim period, any adjustments have to be reflected at the beginning of the fiscal year, and that includes that interim period. All points within the standard have to be adopted in the same period, and then it needs to be adopted using a retrospective approach for each period presented. If it's not practical to do that, the amendments can be applied prospectively as of the earliest dates that's determinable. That's the first point of our cash flow presentation. The second is the presentation of restricted cash. The standard is designed to address diversity in practice related to cash flows, classification of restricted cash. The standard does not define the terms restricted cash or restricted cash equivalents, but states that companies should continue to provide appropriate disclosures about its accounting policies that pertain to restricted cash in accordance with other standards in GAAP. It also doesn't address how an entity determines what restricted cash or restricted cash equivalents are, but the chart that changes could significantly alter the way some companies present and classify restricted cash. The key elements of of this standard, though, are really centered around the restricted cash and cash equivalents need to be included with cash and cash equivalents in the statement of cash flows. There's also a reconciliation between the statement of financial position of the balance sheet and the statement of cash flows when there's a separate presentation of those items on the balance sheet. And then the disclosure requirements regarding restricted cash. An entity with a material balance of restricted cash or cash equivalent amounts generally describes, they must disclose information about the nature of those restrictions. Some practical considerations for accounting teams and CFOs to be aware of: the treatment of potential accounting policy change and the impact that can have if companies are to modify or change their definition of restricted cash or cash equivalents. The communications with executive leadership and boards of directors and bankers in particular, just to let them know what this change is and why it's happening. Ultimately, the impact of does not mean any changes to cash on the financial statements. It's just the way it's presented within the statement of cash flows. And then with your auditors, just work with them to make sure that they understand of any changes that you've made, and they can assist if there's any potential accounting policy changes and how to account for that. This guidance is currently effective for public business entities, and then for everyone else, it'll be effective for this upcoming year for years beginning after December 15th, 2018, in any interim periods. It can be adopted early, and it has to be applied retrospectively for all periods presented. So that wraps up changes to the cash flow statement. Moving on, we're going to touch on some income tax considerations, so specifically the impact of intra-entity transfers of assets other than inventory. So inventory is specifically excluded from this standard, but under current U.S. GAAP, there's a requirement for comprehensive recognition of the income tax effects of transactions when they occur, but there's currently an exception to this rule for intra-entity asset transfers. This new proposed guidance is going to eliminate this exception other than for inventory transfers. And this standard is being proposed, and it's really designed to ensure that an entity's consolidated financial statements reflect the tax consequences, including any deferred taxes, of these intercompany asset transfers when they happen, when they occur. Intracompany transfers of inventory and the recognition of the tax consequences on those will continue to be deferred until the company until the inventory has been sold to an outside party, or that inventory is otherwise left the consolidated group. So until it's disposed of. This standard's effective again currently for public business entities. For private companies and entities other than public business entities, annual reporting periods beginning after December 15, 2018, and any interim periods beginning after December 15, 2019. Companies can early adopt, but they have to do so for the first interim period of an annual period if it issues interim financial statements, and it has to be applied on a modified retrospective basis through a cumulative effect adjustment through equity, including the effect of any valuation allowance at the beginning of the period of adoption. All right, moving on. Next standard we're going to touch on is ASU 2017-01. It's a change to business combinations, and really centers around the change and the clarification of the definition of a business. So the new standard was issued to clarify that definition, and it's really the starting point in determination of whether or not a transaction should be accounted for as an acquisition or disposal of assets or businesses. And the primary focus of the ASU is to narrow the definition of what a business is. I'm going to touch briefly on the current guidance versus kind of what the new guidance is. So under current guidance, there's three specific elements of a business, and those are inputs, processes, and outputs. The standard says that while an integrated set of assets and activities that is a business usually has outputs are not actually required for the transaction to be accounted for as a business combination. All inputs and processes that a seller uses in operating their business don't have to be acquired by a purchaser if a market participant can acquire the assets and activities and continue to produce outputs For example, by integrating the acquired assets and activities with their own inputs and processes. Based on the application of the way that the standard currently reads, this has resulted in a lot of transactions being accounted for as a business combination rather than an asset purchase. And for those who've been through the process, business combination accounting is much more complicated than asset purchase accounting. So the goal is to narrow the scope of that. They presented a new definition of what a business is. The revised guidance and the revised definition specifically says it's an integrated set of activities and assets that's capable of being conducted and managed to provide a return through dividends, lower costs, or other benefits to investors or other owners. To be able to qualify and meet the criteria of that new definition, an integrated set of activities and assets requires inputs and process related to those inputs. The minimum requirements to meet that definition, a business doesn't have to include all the inputs or processes that a seller used to operate that business, but to be considered a business at a minimum, it has to include an input and a substantive process that together contribute to the ability to create outputs. And within the new guidance, there's a screen that's been developed to help companies in making that determination of whether or not a transaction qualifies as a business or as an asset purchase. Specifically, the new standard says that the screen really centers around the concentration of the fair value of the assets acquired. Specifically, that if substantially all the fair value of the gross assets acquired is concentrated in a single asset or group of similar assets, it does not meet the definition of a business. The standard provides a lot of practical guidance that will help clarify this. But the ultimate goal of this is it's going to result in a lot of transactions that were previously accounted for as business combinations under the previous guidance to be accounted for as an asset purchase under the new standard. Again, the standard has a lot of guidance for industries, specifically things like real estate, biotechnology, and financial institutions. They have significant impacts, but there are a lot of illustrations and examples provided in the standards. All right, moving forward, the framework for determining whether or not a target or a group of assets acquired, if it includes an input and a substantive process in order to meet the definition of a business, the test is to determine whether that set has outputs. And the new standard narrows the definition of what an output is to be consistent with the guidance in ASC 606 under the new revenue recognition standard. And specifically, it's trying to narrow it to the point where the outputs are the result of specific inputs and processes applied to those inputs to provide goods or services to customers, generate investment incomes or other revenues. And then ultimately, there is some guidance as well for evaluating sets with and without outputs, and how to determine if each of those meets the definition of a business under the new definition. And the guidance on that is pretty extensive, but it largely centers around whether or not an acquirer obtains an established workforce and the impact of that workforce on the generation of outputs. This guidance is effective for public companies this year, and for everybody else, it's going to be effective for years ending after December 15, 2018, so for 2019 calendar year and organizations. Early adoption is permitted in some cases, but is not required. I'm not going to read all that, but it really centers around the issuance dates of the amendments. Okay, the next point that we'll touch on is some changes to the test for goodwill impairment. This standard was designed to simplify goodwill impairment, to test and provide cost savings for companies. It eliminates the second step from the two-step requirement regarding goodwill, and really determine the fair value of individual assets and liabilities to calculate and apply goodwill. That's no longer required. The new requirements are to perform an impairment test to determine whether or not the carrying value exceeds the fair value of your goodwill, and if it does, then that's the impairment amount. If your fair value exceeds your carrying value, then there's no impairment. Some practical consideration points. This step is the standard is pretty straightforward, pretty simple. But the practical considerations are: consider the effect on income taxes. So the income tax effect from any deductible goodwill needs to be factored in the carrying amount of that reporting unit. The new standard does provide some illustrations on how to demonstrate this. There's some optional qualitative assessments, meaning that entities can still perform the qualitative assessment to determine if it's more likely than not than impairment exists. There's some expanded disclosure requirements, specifically when a reporting unit has a zero or negative carrying amount. There are additional expanded disclosure requirements to disclose the amount of goodwill allocated to it and the reportable segment in which it's included. This change does not impact the private company accounting alternative provided under ASU 2014-02. So private companies will still be able to amortize goodwill if they elect to do so. This standard is going to be effective for public entities that file with the SEC beginning in years after December 15, 2019, and public entities that don't file with the SEC will have to adopt this standard beginning after December 15, 2020. And for everybody else, including not-for-profit organizations, this standard is going to be effective for years beginning after December 15, 2021. So the standard is going to be adopted prospectively. Early adoption is permitted beginning after January 1st, 2017. Okay, moving on. There are a couple of big changes to financial assets and liabilities and fair value in particular. The first that we're going to touch on is ASU 2016-01, and it impacts the recognition and measurement of financial assets and financial liabilities. And the purpose of this guidance was to simplify the accounting for these financial instruments and to provide better decision-useful information to users of financial statements. It specifically makes improvements to how entities account for equity investments, how they present and disclose these financial instruments, and then measure any valuation allowance on deferred tax assets that are related to available for sale debt securities. We're not going to go through each of these points, but there are some things I do want to hit on that I think are important that companies be aware of. The first is that all equity investments within the scope of the standard have to be measured at fair value, and this changes in fair value will be reported through net income. The standard does define what an equity investment consists of for purposes of this guidance, and specifically it states that all equity and securities, partnership interests, and ownership interests in both unincorporated joint ventures and limited liability companies qualify as equity investments for purposes of the standard. It also excludes certain things, including derivatives, equity investments that are accounted for under the equity method, equity investments that require the investor to consolidate the investee, ownership interest in an exchange. Really, this is applicable for broker-dealers and depository and lending institutions. And then finally, Federal Home Loan Bank and Federal Reserve Bank stock. Excuse me. There is a measurement exception for certain types of investments that the standard setters believed would help provide some practical expedience and some relief from having to fair value these assets, certain types of assets. So specifically, equity investments that don't have a readily determinable fair value and don't qualify to be measured using the practical expedience to estimate fair value at net asset value. Those can be scoped out from this standard. It does allow investees to be measured at their cost, less any impairment, plus or minus any changes resulting from observable price changes in orderly transactions for identical or similar investments of the same issuer. I don't know that that'll have a wide scope impact on investments, but that clause is there. And then finally, equity investments that are measured using the measurement exception have to be qualitatively evaluated for impairment at each reporting period. So because they're not being fair valued, they do have to be reviewed for impairment on an ongoing basis. the determination of whether or not this measurement exception applies has to be done separately for each investment. And once that election's been made, it needs to continue to use that measurement exception unless the underlying investment obtains a readily determinable fair value. It's eligible to be measured at NAV of the investee, or it no longer falls within the scope of ASC 321. And if there is a change in the measurement method of an equity investment using that measurement exception, it's likely a change in accounting policy under ASC 250, unless it meets one of the criteria that's listed above. And again, reach out to your auditors and talk to them about any potential changes here. They can assist with how these things need to be disclosed and presented in the financial statements or communicated to internally to the board of directors. Got about 15 minutes left. We're making pretty good progress through this. There's a couple other standards that we're going to touch on. The biggest one remaining revolves around changes to the disclosures around fair value measurement. This falls under ASU 2018-13, and the purpose of this proposed guidance, this is issued as part of the FASB's disclosure framework project to improve the effectiveness of the disclosures in the notes for the financial statements and to provide readers of the financial statements with improved visibility and information they can use to make timely and effective decisions. So the standard changes the following. So specifically, there's been some removals, some modifications, and some additions to what the requirements are. The transfers between level 1 and level 2 investments within the fair value hierarchy, the requirement to disclose those has been removed. The policy for timing of transfers between levels of the fair value hierarchy has also been removed. The valuation process for level 3 fair value measurements has been removed. There have been some changes that revolve around the valuation of level 3 measurements, but we'll touch on those in just a minute. And then for non-public companies or organizations, changes in the unrealized gains and losses for the period, including any earnings for recurring level 3 fair value measurements held at the end of the reporting period. So all of those disclosure requirements have been removed from the standard. As I mentioned, there's also some changes, some modifications to existing disclosure requirements, really revolving around level 3 investments, and specifically the roll forward of level 3 investments. In lieu of a roll forward for these types of investments, a non-public entity is required to disclose transfers into and out of these level 3 category, and then disclose any purchases and issues of level 3 assets and liabilities. The second point that's been modified is the investments in certain entities that calculate net asset value. An entity is required to disclose the timing of the liquidation of an investee's assets and the date any restrictions or redemption may lapse, only if the investee has communicated the timing to the reporting entity or announced the timing publicly. If that timing is not known, the reporting entity just has to disclose that fact. And finally, the final modification to the current disclosure requirements centers around the measurement uncertainty disclosures. And really, the amendments clarify that measurement uncertainty disclosures are designed to communicate information about the uncertainty in measurements as of the reporting date for any recurring fair value measurements categorized within level 3 of the hierarchy. A narrative description of that uncertainty from the use of significant unobservable inputs needs to be required, specifically if those inputs reasonably could have been different at the reporting date. The final kind of changes to the disclosure requirements, there are some new disclosure requirements for level 3 investments and unobservable inputs. For level 3 investments, for any recurring fair value measurements categorized as level 3 that are held at the end of the reporting period, the changes in unrealized gains and losses for that period that are included in other comprehensive income have to be disclosed. And then for any unobservable inputs, the range and weighted average of significant unobservable inputs used to develop any level 3 fair value measurements have to be disclosed. If there are unobservable inputs, the standard does allow entities to disclose other quantitative information available, things like the median or average of those inputs, instead of the weighted average, if a determination is made that the qualitative information is more useful and rational method to reflect the distribution of these inputs within the fair value measurements for level 3 investments. To wrap up the discussion on changes to the framework around the disclosures for fair value measurement, effective dates. So this is going to be effective for all entities for fiscal years and interim periods within the years bidding after December 15, 2019. So everybody still has at least a year before this is going to become a requirement. Early adoption is permitted once the ASU has been finalized. And then if once the standard's adopted, the standard should be applied retrospectively to all periods presented, with certain exceptions, and specifically, except for when there's amendments on changes in unrealized gains and losses. The range and weighted average of significant unobservable inputs used to develop the level 3 fair value measurements, and a narrative description of measurement uncertainty that needs to be applied prospectively for only the most recent interim or annual periods presented in its initial year of adoption. So with that, I know there's a lot of content kind of coming right at you, but with that, we're going to move on to polling question number 3.
Yes, and so what we want to ask is, what impact do you expect the new standard on fair value measurements to have on your organization? So is that significant modifications will be required to your current disclosures, minimal changes will be made to the current disclosures, or not sure yet, we're still evaluating, or not applicable? We'll go ahead and give everyone just a few more seconds to answer that question. Okay, and we'll go ahead and give everyone 3 more seconds, and we'll close the polls in 3, 2, 1, and share the results. There you go.
All right, thank you, Marie.
Yeah, of course.
Yeah, it looks like there's some people who are still unsure. Some people who think it'll have a minimal change. I think some of the people that probably should pay attention to it, anyone with an employee benefit plan, it'll have an effect there on how you disclose and record transactions for those activities for investments, financial services, most importantly, not-for-profits. So definitely some things to consider there for the changes that are upcoming for the industries that we just mentioned. All right, then to wrap it up, we've got a few minutes left, and we'll close this out real quick, but we'll move on to ASU 2018-18.
There's really just 2 standards left we want to touch on, and there are some other topics that are out there that we'll mention. Obviously, don't have time to get into everything today with the time restrictions that we have, but ASU 2018-18 speaks to collaborative arrangements, and the standard is designed to clarify the interaction between the standard on collaborative arrangements and the new guidance under revenue recognition 606. Under the current definition of collaborative arrangement with ASC 808, it states that the collaborative arrangements provides guidance on the income statement presentation, classification, and disclosures for these collaborative arrangements, but does not specifically address the recognition and measurement issues, including how the appropriate unit of accounting is measured and when the revenue recognition criteria have been met. To help with that, the new standard has provided some new guidance on unit of accounting, and specifically it adds guidance to topic 808 that aligns with the new guidance in topic 606, and spells out, it gives an example that states that it's a distinct good or service limited to when an entity is assessing the scope of ASC 606. Accounting for transactions when the counterparty is a customer, the standard clarifies that in the context of the unit of account, ASC 606 should apply in its entirety to these transactions within a collaborative arrangement when the counterparty is a customer. When the counterparty is not a customer and the transaction is not directly related to third-party sales, presentation of the transaction as revenue is precluded if the collaborative participant in the counterparty is not a customer. This standard is going to be effective for companies when they initially adopt ASC 606. So for public companies, it's already going to be effective. For private entities or those who have not adopted 606 yet, it's going to be adopted once they adopt 606. A final effective date for this ASU has not been established, but it will be established once it's going forward. And then finally, the last thing that we want to touch on, make people aware of as they get ready for year-end, is a recent pronouncement just came out a couple of weeks ago from the Private Company Council and the FASB regarding improvements to the related party guidance for variable interest entities. And really, it's designed to expand the private company alternative that allows private companies the option to not apply the variable interest entity guidance to qualifying common control leasing arrangements. So the common situation is that there's an owner of a company owns the building through one company and then has an operating entity that leases the building from that owner in a second company, an operating company. And then under the initial VIE rules, that building, the entity that controlled the building would have to be consolidated into the combined financial statements unless some specific criteria were met. There was a private company exception that came out, was issued, that allowed private companies to not have to combine or consolidate that leasing arrangement in their financial statements. But the amendment broadens the scope of the guidance to really include all common control arrangements that meet some specific criteria and expands outside of just leasing arrangements. Under the new standard, companies can make an accounting policy election to not evaluate a legal entity under the VIE guidance if all the following 4 criteria are met. The first is that reporting entity and a legal entity are under common control. The reporting entity and a legal entity are not under control of a public business entity. The legal entity under common control is not a public business entity, and the reporting entity does not directly or indirectly have a controlling financial interest in that legal entity when considering the requirements of ASC Topic 810. And really, the VIE subsections of Topic 805 don't apply when making that determination. The impact of this alternative, it's an accounting policy election that has to be applied consistently to all legal entities that meet the requirements that we just talked about. Entities that elect that alternative also has to provide some additional disclosures, but it no longer requires entities with common indirect interest held through related parties under common control when assessing a decision-making fee as a variable interest. Instead, the reporting entity considers such indirect interest on a proportionate basis. This standard is going to be effective for private entities for fiscal years beginning after December 15th, 2020. Early adoption is permitted, but it should provide some relief under the VIE guidance for private companies. Some other topics that we haven't had a chance, just based on time requirements, to touch on. There have been several updates and changes for hedge accounting, stock-based compensation, and specifically around stock options granted to non-employees, and designed to modify the guidance there to make things consistent with those granted to employees. The measurement of credit losses on financial instruments. For not-for-profit entities specifically, there's new guidance to clarify the scope of the accounting guidance for contributions received and contributions made. And then for technology companies, internal use software, customers accounting for implementation costs incurred in a cloud computing arrangement that's defined and classified as a service contract. So with that, if there are questions on those topics, please feel free to reach out to us. We're happy to provide guidance and more information there and how they can apply to your organization specifically, and then what you as an accounting leader can do to prepare for those standards. With that brings us to polling question number 4.
Perfect. So what we want to ask this time is, which pending guidance do you believe will have the biggest impact on your organization? Is that RevRec, lease accounting, fair value measurements and disclosures, or is there something else? So go ahead and answer this last polling question. Just as a reminder, if you missed one of the earlier ones, this is your last chance. And we'll also be sending out the recording of the presentation and the slide deck within the next 48 hours. Okay, we'll give everyone just a few more seconds here. Okay, and we'll go ahead and close the polls in 3, 2, 1, and see what's going on.
Yeah, and that's exactly what we expect to see from most of the clients that we serve in this area in the middle market and facing nonprofit. Changes RevRec and lease accounting, it's on everyone's minds. We know there's a lot of information that's coming down the pike and discussed today. We could probably spend a couple of days just going through each of these topics in more details. So we appreciate you guys joining us this hour to kind of go through a high-level overview. One of the things just touch upon, like Isaac said, was as you have questions and you start to assess the impact on how this is going to affect your accounting and reporting for your organization, we want to be a resource and we're available to you. If there's a specific question that you have related to your organization, please reach out to us. We're happy to answer any questions and be a resource to you. So it looks like we have 1 minute to spare. So with that, we will thank everyone. We hope you have a great afternoon and look forward to talking with you on the next update that we do.
You'll be getting some evaluations for this presentation. We love any feedback that you have. This is the first year-end update that we've done, and ultimately we'd like to get to a point where we can really dig into the standards that are going to be most applicable for our clients or potential clients, and really speak to how it impacts the accounting leaders themselves and how they can communicate that effectively within the organization and externally from the organization. So any feedback is really appreciated. And with that, do you have any questions, or are we good?
We are good to go.
Okay.
All right.
Thanks so much for your time, everyone.